Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Gemini Real Estate Advisors LLC, Genova, Burns and Giantomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling & Sterling, Stephen Napolitano, The WITKOFF Group, Urban American.
They call them the counselors, the conciliers, the men behind the business, the advisors to the trade. These are the people who help the major real estate owners around the world make decisions. So I brought together the conciliers, aka the attorneys, of these major law firms to provide their insight on the state of the market today. My guests include Ken Laurie, who is the co-chair of the practice at Bingham McCutcheon, Robin Panofka, who is the co-chair of the practice of Wachtell, Lipton, Rosen, and
Katz.
Okay. Jay Epstein, who is the chair of the real estate practice at DOA Piper, and last but not least, a man who's been here a number of times, my friend Robert Ivanhoe, who's the chair of the law firm of Greenberg Traurig. So, Rob, you've been here, these are rookies. They haven't been here.
Hardly rookies.
Okay? They're not rookies in the profession. No. They're rookies over here. Has real estate returned too quickly this year? What's happening?
Well, I think that the bounce back has exceeded what certainly I would have expected, and I think most people expected, and I think there are a number of reasons for that. And a lot of people are a little bit concerned that it may be overreaching, what it should be right now. I think some of the factors of that are there's a lot more capital out there than people expected, particularly in the debt side, which has recovered more quickly than most people anticipated, and a lot fewer good things for sale. So when something appears for sale, there's a swarm, and that drives up the prices.
It's interesting. I was interviewing someone yesterday for my show, Building New York Life Stories, and the guy is 76, 77, and he's been in the real estate business for, let's say, 50 years. And he said, 30, 40 years ago, I'd go to the 60 East Club, a broker would bring me a deal, it would be my deal. Today, brokers don't bring me a deal. 100 people see the same deals. What are you seeing over there? I mean, because I have two gentlemen who share New York and Washington as their home. What are you seeing?
Well, I think we're seeing just what Rob said, that there are, and as you're saying, Mike, the deals are back. There's a lot of capital chasing deals. I think the other reason is it's about jobs. 2 years ago, when the jobs were going down through the bottom, and we were seeing millions of jobs lost each month. People weren't going to shopping centers, people weren't buying houses, people weren't expanding their office spaces. So as the job markets come back, we're seeing a lot more activity.
It's an interesting talk with regard, I agree with you that the jobs are coming back, but I'm going to disagree with you a little bit on the office space, because I mean, you haven't relocated your office, but I did a show on the anatomy of 11 Times Square, and when I had Proskauer, because I wanted to bring everyone, Proskauer said they just signed the same amount of square footage because today you're not utilizing the same space. I mean, at one time you used to have an administrative assistant who would handle 3 attorneys. Maybe that administrative assistant is handling 5 attorneys. You don't have law libraries anymore. You have off-sites, you know, the data processing. So there's more efficiency in space.
There's no question that most, I think, big office tenants are leasing less space now when they move. Accenture in Washington is reducing their space from 200,000 to less than 100,000. They're in the market now. But it's still creating activity, because people are feeling better about where the economy sits and what they're doing going forward. So from the perspective of all of our clients, there are people moving.
Yeah, we were talking about REITs. Where do you see REITs today? I mean, REITs have been, you know, it's been the stock market's favorite thing for the last couple of years. You know, even in the first quarter this year, it's continued to do that. You represent a lot of REITs and public companies. Where do you see them today?
REITs have rebounded in a remarkable way. If you look at the REIT stock index, the RMZ, at the bottom of the financial crisis, it was trading at around 300. It's over 800 today in a couple of years. So a massive rebound in the REIT market. And many are saying, and I'm a believer, that we're entering a new REIT golden wave where more and more commercial real estate, all of the assets you guys play with, are going to move into the public markets through a lot of M&A activity, which is mostly what we do. And the REIT market, which today is about a 350 billion market, should be at 700-800 billion within about 4 or 5 years.
Now the question is for anyone to, you know, I'm not bringing it to you, Robin, could be to Ken or anyone else. Do we see the merger of certain REITs, or do we see companies or families who have been operating individually becoming REITs or being absorbed by REITs?
Yes.
Yeah, I think you're seeing all of that. The question really is, if you want to capitalize on your real estate, where's the best way to do it? And as we were talking about earlier, a lot of people would like to create their own REITs, but in today's world, you got to have a very substantial sized REIT, you know, several $1 billion in order to go public, and there aren't that many people that have that. So you've got somebody that has a significant portfolio that a number of years ago might have been able to go on public with an IPO with a REIT. Today, can't do it at the prices that they think the properties should demand. So they either stay and hold what they've got, or they talk about selling to a REIT.
What about the families? You know, the third generation who've been in business. Do you see them becoming REITs, or do you see them? You know,
No, generally not. I mean, I think what you sometimes see with the families is if once I have one client who is third generation, he is in his 60s, he has no family who is in his business or has any interest in going in his business, and he is at the point in his life where he doesn't want to keep running his own properties, and so he's talking about an exit strategy. But if you have family that's still interested in running the business and being in the business, I think that they usually don't have a lot of leverage, so there's not a compelling reason for them to exit. And usually they stay in the business unless you have a situation as I just described.
Isn't the real question there, though, if you're not public, right, and you have a choice of rolling up and selling to a public company or going public, wouldn't you much rather not become a public company?
Generally speaking, pure numbers and economics, the answer is yes. I think what may make you want to become a public company is if you want to continue
To grow
running
and
the
grow,
asset.
running and grow.
Yeah.
Grow.
you know,
It's not
and
a-
also, were we talking about the availability of capital? The REITs are able to raise money. You know, they're able to pick up capital. I mean, you know, you can be a REIT, or you can take some money from my friends in the private equity business.
See, that's where I have a different view about families. I think there may be an occasional family that will sell to a REIT and probably less likely actually go public themselves, because at least in New York, most of the families, they're very private. The last thing they want to do is open themselves up to Sarbanes-Oxley and reporting and analyst calls. That's not for most of them. So if they want to get out, they'll sell, and certainly one viable exit strategy is to sell to a REIT. Where I think where you're more likely to find that kind of activity is a lot of the buyers in the last 10 or 15 years have been operators who have gotten a lot of equity leverage from partnering with private equity firms. And as we all know, private equity firms get to the point where they need to exit investments, and they'll look for what's their best exit on an investment. And they will make their operating partners sometimes consider, an exit that the operating partner may not even be interested in, but they can force their hand. And sometimes that exit could be a REIT, IPO, if there's a large enough concentration of assets, or if there's not, selling to a REIT, because the REITs can be the best buyer of these things, and and it's a continuation of institutional management.
Yeah, the REITs have the ability to raise capital, or they have capital. So they don't necessarily, if they see an opportunity, they don't necessarily need to go to a bank and get a loan. It's a huge advantage that they have, and so that they are able to take advantage of opportunities in the marketplace. Somebody was saying before that you were saying it's not like the old days where somebody brought me a deal and it was my deal. Today it's very competitive. There's a good deal, whether it's an existing property or a piece of land to develop or a series of properties. There are a lot of people that are interested, and frequently the one who can pull the lever without a lot of conditions is successful, and that means the REITs in many cases.
You represent, all of you, private equity funds. What do you see them doing? What are they? Are they buying distressed debt? Are they buying assets? Where's the market, Robin?
Well, the last couple of years, clearly they've been buying debt. The debt was the new equity, as people said, and I think that's going to continue for some time. But in some respects, if you think about the REIT model and how it plays with private equity, REITs are good at owning stable assets that throw off stable cash flow. They're less good at owning messy situations, distressed properties that are under development, and that's where private equity can often fit in very well. Take a troubled situation, troubled asset, get it nice and stable, and then sell it to a REIT.
But in many cases, most of the private equities always partner up with someone because they don't always have the assets, the manpower.
Well, they don't have the operating
experience to do that business.
Right, so they've got to find partners, and there's obviously, that goes back to what we were saying in the beginning, there's all this capital looking for places to work, so they've got to partner up in places where they can put it to work, get their returns, and as Robin says, jump back out.
I wrote an article a couple of months ago. I was talking about, AFIRE, the Association of Foreign Investors. Every foreign investor wants to come to America, and I was bringing out the subject of the state of Israel, that 20 years ago, 30 years ago, you had that individual who was the small entrepreneur who wanted to buy a building or something like that. Now you have the finance companies, you have the insurance companies, you have a totally different investor. What are you seeing with regard to foreign investors?
You have sovereign wealth funds. I mean,
no question. Sovereign wealth funds.
I mean, we've seen a lot of foreign money interested in coming in, and sometimes in very big chunks, and flexible, and again, like what I was saying about the REITs, the ability to move quickly, although sometimes they don't move so quickly because they're very cautious. But a lot of people think that U.S. real estate is a good place to be, and diversity. And
I mean, if you look at it this recently, the Australian fund, which is like the 17th largest sovereign wealth fund, came in and partnered with TIAA-CREF on 685 3rd Avenue. They had never been here before. So, needless to say, the sovereign wealth funds are coming in.
But they tend to move slowly. They tend to have advisors. We're doing something now for one of our pension fund advisory clients. They're about to announce, it'll probably be announced in the next day or two, a very large acquisition in New York of an asset, and it's being done by a foreign sovereign wealth type fund, but they're acting through their pension fund advisor, and the process to get things done is very slow. They have like a 60-day approval process over in the foreign country.
Now, what about the Chinese? I mean, the Chinese last year, especially for your clients, I know in New York, they lent the money. They were the big players.
On the debt side,
the Bank of China was
on the debt side. They've been very active. There's been talk about, CIC coming in and investing all this money, and it really hasn't happened. There hasn't been much direct investment from CIC. I know that there's been some. They have gatekeepers that they tend to use to make sure that they're not familiar with how it works here and who the right people to align.
So are they using the Townsends and the
Yes.
Cortlands
Yes.
For the gatekeepers?
Yes.
They're also coming in. I think there may be more of the sovereign wealth money around than people realize, because in some cases they're investing through funds. One of the
Advisors,
advantages
yeah.
of real estate, if you're a sovereign wealth fund, is unlike buying a public company or some major asset type that creates a political stir, you can buy real estate through advisors, through funds, quite in a quiet way. And so I think there's actually more foreign money out there.
Now, does the foreign money, the sovereign wealth funds and the other foreign, do they have the same limitations? You brought up a very interesting point, and I was with someone yesterday who told me that a major fund he's with is telling him that he has to sell this asset. And he really doesn't want to sell the asset,
Happens all the
but
time.
the lifespan of the fund is over, and they've been good to him. He says, I'll pay the recapture and I'll live that. Do you see the sovereign wealth funds having this 7-year hold, or is it a longer hold?
In a direct investment, no, but they still may have their own reasons why they decide they need to sell.
But there's no question that the foreign investors, both on the sovereign wealth fund and on the private side, believe just what Ken said. This is a very safe and secure place, at least in New York and Washington, to invest your money. We were at the MIPIM conference back in March, and the energy and the interest in U.S. investment from the German funds, the Dutch funds, the Israelis, it's clear, and it's happening. And in fact, they generally have lower return hurdles, right? So they're happy to invest at the sub-5 caps, and they're the ones that drove the prices up.
And they
in a
will
lot of
wait. They'll be
situations.
patient,
Now,
too.
what, we
And
were talking.
they have different rules. I mean, some of their tax rules, like the German tax rules, for example, provide real incentives to invest in U.S. real estate that
Tremendous.
that others
nobody
don't have. So you
but
see,
that's why you had Jamestown and Paramount over here for years. I mean, this
Right.
is, this is something over there in this situation. Jay brought up a comment before, about retail being well. I mean, with oil prices, food prices, everything's going up. Retail is hurting in certain parts. I mean, it's not the same. I mean, you talk about New York City, but I'll go to New Jersey, the retail is not that good. Parts of Westchester, it's not that good. Urban retail is fine. But how do you see the retail market,
Well,
general with your clients?
I mean, the oil prices are a wild card out there, right? For not just retail, right? If the oil stays at $100 a barrel for some long period of time, it's going to have a broad effect on the whole economy. So is it going to affect retail? Sure, people may not drive as much to malls, but as you read just yesterday, right, in the Journal, you got 40 malls for sale, right, from Westfield and Simon and General Growth. So those guys obviously think there's a market out there for selling, and they're pretty clear. They're not selling their A properties, right? They're selling their B properties to try and raise capital to pay down debt and go off and do other things.
But in the same manner, if you look at retail, 10 years ago there were companies like Sam Goody. Now there's no more Sam Goody.
There's no more records.
There are no
No
more
more
records.
records. Look at Borders and
that's what I'm trying to bring out. There are the bookstores are leaving that market.
Yes.
So when you lose certain type of endeavors, and they said that Best Buy, which is one of the few major electronics chain, they're going to cut down their size of stores. So there's a difference. There was a very interesting article about the kiosks, that the kiosks do very well because they're like the pop-up stores that open up over there in the market.
well, some people, and I've seen this in some areas are over retailed. And so you'll see in some areas, if you've got you've got a piece of property that's currently a mall, it may end up being a high-rise apartment building. It may be something else, because I think you're going to see a lot of that. That's how you're going to deal with the oversupply.
You bring up the point of residential. I mean, of all asset classes today, I think residential has improved, and that's the main investor.
multifamily.
Multifamily. I'm talking rent regulated or even any rental multifamily.
But why is that? It's because Fannie and Freddie kept lending, right?
So that brings out an
That
interesting
kept it healthy.
That kept it healthy. The
You know what?
capital was there.
But that's not the only reason, but it
more
certainly
rent
helped. It helped.
No, but I'd like to get on this, Jay, subject, because every time that I have my friend Joe Fickler of New York Community Bank, he has a pet peeve. He's a major multifamily lender, and he is really angry at Fannie and Freddie when they lend $150 million for a Class A rental building in Manhattan and give 30-year financing. He says that's not the mission of Fannie and Freddie. And that's the real question. What should Fannie and Freddie be doing?
Well, a lot of those, but not all of those, have affordable components in them.
I'm talking
Yeah.
about the ones at the 20%. I'm talking total market rate buildings in New York City have been financed by Fannie and Freddie without any affordable component.
You know, there are a lot of arguments back and forth. The people that want to get rid of Fannie and Freddie say that even though they may be saving homeowners or owners of multifamily a half a point or something like that, that the cost to the Treasury, because those securities are competing with Treasury, is so great that you should get rid of it. The one thing I would want to say about Fannie and Freddie is that if we didn't have Fannie and Freddie during the last financial crisis, okay, if people thought that the values of their homes went down before, if they couldn't have gotten those loans, and if the maximum amount of those loans on single family and on multifamily wasn't there,
There would have been no market.
there would have been no market. And all the people that are complaining in Congress that their constituents' houses are worth less than they were and what have you would be singing another tune. So there's two sides of any argument.
No question. What about CMBS? It's back, you know, it's like happy
2.0.
days are again, right?
2.0.
What happened?
Well, I think that the recovery in the underlying market and people's hunger for yield brought it back, and we'll see how far the envelope gets pushed and how they're underwritten and how the subordination levels work. And
And how do you see that? Do you see that, has it changed? Are they more conservative?
Well, lenders have a very good short-term memory. So
I think you put it very well.
I think at the moment,
Short-term memory.
just what Rob said, at the moment, the underwriting standards are very tough.
Yeah.
We'll see where it is.
You're seeing
2 or
mostly
3 years from now.
60%
Are-
loan-to-value loans, not 80%.
But
right,
you're
sure.
seeing the banks. We were talking prior to saying that Wells Fargo today has become the interesting thing is in New York City you see Wachovia is now Wells Fargo. It looks like they literally came in with their stagecoaches and are giving away money. I mean, they are the most aggressive. You know, when a friend of mine from Bank of America says to me, "I'm afraid I won't make my numbers," you know, they said every deal we're losing to Wells Fargo. You know, Capital One is saying all these players over there.
Yeah, I don't know that they're giving away money. First of all,
No, I didn't say
they're
they're
being
giving away-
compensated very well for it, first of all. And secondly, I think the problem that your friend is having and that people are having generally is that there are a lot of lenders that would like to get money out that a year and a half ago weren't interested in playing.
Can I agree with you? But
they
you know
lost
what?
ground.
But
They
the
lost
world
market
has also
share.
changed in that market. A year ago, a loan like at 100 Park Avenue, which was $130 million, it was a syndicate of, it was a club deal of about 8 lenders. Today, you have an M&T or a Capital One or a Wells Fargo. They'll take that down themselves. They're not worried about it. The only reason they'll do a club is that they can keep their friends happy on that situation over there. But there's a big question. There's a lot of CMBS debt that was written in 2007, 2006 that didn't make sense. That the rents, were predicated on $130 a square foot rent. What's going to happen there?
Well, that's why we're not out of it yet. And there's a big wall that's going to be hit in the next few years. And there were a lot of 5-year loans that are going to mature in a year or two. There were a lot of 7-year loans, and there actually were a lot of 10-year loans. So, we're going to be in this until 2017, and there are going to be maturing loans that, because of the way they were underwritten and the amount of leverage and projecting, higher and higher rents, they're going to, run out of runway, and there's going to be continuing distress while the market's improving.
Here's a question which I've posed to some bankers, so I asked their counselors of this. In the mid-'90s, if somebody fought with their banker about a loan, maybe they gave you, as we would call it, the scarlet letter that you were a bad person, we shouldn't do business. Today, has that changed? I mean, the banks that I talk to, they say, if a person, even though they gave us the property back, but they were reasonable in their negotiation.
It's changed, but for a lot of different reasons. It's changed dramatically. Back in the 90s, people would fight with banks more. There weren't these non-recourse carve-out guarantees that would now make people behave better. So back then there was nothing to prevent them from, lender liability lawsuits, bankruptcy filings, and all of that.
Bankruptcies.
Yeah, and there was a lot of that going on, right? They changed the bankruptcy code, as Jay correctly points out. So there are a lot of reasons today why there's much less fighting going on, and what you're seeing a lot of now is borrowers who realize that it's hopeless for them. They're so far out of the money. There's very little reason to hang around. They have these guarantees out there if they behave badly, and they'd rather say to the bank. And I have clients today who are acting this way, who were the ones who were suing banks 15 years ago, but now they're saying, what would you like me to do? I'll give you the keys. I'll run it for you. I'll do whatever you want.
There's also a very different attitude from the banks, from the lenders.
Completely.
The extend and pretend mentality. I mean, for one thing, what's been happening is for the floating rate debt out there, which has been at LIBOR plus something, it's so cheap that even an asset that is throwing off relatively little
But that's
cash
why
flow,
the property is not in default.
Right.
That's why you can pretend.
You can pretend.
And lenders are
when
extending.
LIBOR is 1/4%, it's
Exactly.
a big situation. But what happens, because certain economists do believe that the interest rates are going to go up, and they have to go up, especially with inflation and all the rest. What's going to happen then?
that could have a major impact, no question. I mean,
That'll add
that's
to
what's
the
driving a lot of this is low interest rates. But there's reason to be optimistic. I mean, values have come back incredibly quickly. There is this wall of capital that wants to invest in U.S. real estate. And as we were talking about earlier, REITs tend to be a leading indicator of values, and REITs are trading at a 15% premium to asset values, which indicates to me that values are going to continue going up quite a bit before they level off.
And,
So
and the other thing is that when you have inflation, which drives interest rates up, frequently it also drives rents up. So there is an equilibrium. Some of the people that had floating rate debt survived very nicely, thank you, because while rents went down, so did their interest rates. And so the reverse can happen as well, if you're not tied into really long-term bad leases.
And if you're in really good cities. Remember,
That's
Yeah,
managed.
we're
There's
lucky.
only half a
We're
dozen
lucky.
or
We're
so
all in the
gateway
good
cities,
cities.
right?
There aren't a lot of
You're in the gateway cities. So
Yeah.
I'd say that the counselors to the major real estate people have provided me and my audience some great insights. So I'd like to thank Ken Laurie, Robin Panofka, Jay Epstein, and Rob Ivanhoe. See you next week.
Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Giantomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling & Sterling, Stephen Napolitano, The WITKOFF Group, Urban American.